Please keep your mic muted during the. You can turn it on during the. You can turn it on at the end when it's time for question or discussion. If you have any question, feel free to type them in the chat box, and we will address them. At the end of the session, make sure to share your name, institution name, in the chat box.
Okay, shall we?
Yeah, wait, sir. Rishabh, you can give introduction about, sir.
Yes, sir. Yes, sir. Some network issues there. Wait, sir. So, sir, I am audible now?
Yes,
Yes,
you're audible.
you are audible.
Okay. So, good evening, everyone. General instructions. Please keep your mic muted during the session. You can turn it on at the end when it's time for question or discussion. If you have any question, feel free to type them in the chat box and we will address them. At the end of the session, make sure to share your name and institution name in the chat box. And one last request that those who have not joined during that registration email, please join through your registered email ID and all change your name. So it gives me a pleasure to welcome you all to the third day of the Faculty Development Program on Financial Analytics. It's a joy to welcome Prasad J. Kulkarni, our estimated guest faculty of School of Management and participants for this FDP program. Prasad J. Kulkarni is a seasoned finance professional with an experience of 23 years of in corporate finance, accounting, merger and acquisition, IPOs, financial restructuring, and digital banking. With 9+ years in a startup, he specialized in finance, compliances, management information system, and business strategy. He has played key roles in balance restructuring, ERP implementation, working capital optimization, and finance across North America and Middle East. As a director, mentor, and visiting faculty, he actively contributes to finance education, e-commerce, and startup growth. A certified public accountant in USA and chartered accountant in India, Prasad is passionate about business innovation, automation, and process improvement, helping organizations drive financial efficiency and strategic expansion. Over to you, sir, to address the topic, my marginal costing tools using Excel.
Thank you, Mr. Rishabh. Really appreciate your kind words. And thank you, Dr. Baba, for allowing me to participate in your MDP program. It is indeed a great privilege to be interacting with your esteemed faculty members, enhance their knowledge. So I'll be doing a very small contribution about whatever I have learned over last 20, 25 years, connecting the dots between the financial numbers using Excel and deriving some meaningful insights or analysis from those numbers. So Excel has been one of the key aspects of my career of over last 25 years, and it has been a game changer for me. Interacting with students, interacting with several corporates, Excel will help you in articulating those numbers in a very meaningful and in a very profound way. The analytics that you will be able to derive using Excel is just boundless. The kind of development that have happened in Excel over last 15, 20 years. I remember my days when I used to use Lotus 123. I don't know how many of you have used it, but Lotus 123 in the 90s, it was one of the, it was a spreadsheet, just like Excel is a spreadsheet. It was a spreadsheet that we used to use to create balance sheets and P&Ls. It was a very primitive way when I look back 25 years ago. I mean, it was a very primitive way the way in which we used to create all the financial statements. But today, just at a click of a button, you would be able to create so many reports from the same set of data. The layers that you can create using Excel to that same level, same data points is extremely profound. So without wasting a lot of time, what I'm going to do today is, as I understand from Dr. Baba sir, that we will be focusing more on Excel. I will be talking about marginal costing in general and introducing you to the Excel tools, how to use marginal costing analysis using Excel. So I think very quickly I'm going to run through the PPT in maybe 10 minutes only, and then later 50 minutes or more than that, if time permits, we will spend more time in Excel talking about references, talking about what if analysis, talking about scenario managers, talking about break even analysis, talking about a little bit of automation, talking about one last chapter that if time permits we'll talk about combo boxes like scrollers, etc. So I'll introduce you to combo boxes, which is a very vital tool if you have to do automation on the same set of data, can create different reports, charts, whatever. So there are several things that we can do. So let's very quickly begin today. So the topic that has been assigned to me is marginal costing tools, contribution margin, break even analysis, and scenario modeling. Sir, just one question that I have. Are all the faculty members who are participating commerce faculties or non-commerce faculties also?
Yes, basically all are from commerce.
Fantastic. So that I
Any
don't have to
faculty they are not there, let them put in the chat.
Okay, fair enough. So marginal costing, I mean, marginal costing is one of the most important topics that when it comes to management accounting. So I'm not talking about costing per se. Even the Indian Institute of Cost and Management Accountants now, Cost and Works Management Accountants is now called as management accountants. So cost management accountants. Management accounting has become a very vital cog in the wheel when it comes to decision making. Decision making, marginal costing will be used typically for very short term to medium term decision making. So whether I should buy or whether I should do in house, whether I should rent or whether I should buy a new facility, what should be the pricing if I have a capacity or if I don't have a capacity. So these are some of the decisions that marginal costing will help you analyze. One of the most important aspects of marginal costing is one key that we use. All the past costs that have been incurred in the past, all the costs that have been incurred in the past are called as sunk costs. So we do not take cognizance of all those costs that have incurred in the past. So I might have spent millions of dollars in machinery. When it comes to decision at hand right now, all that cost that I have spent in the past has no relevance per se for the decision that you are going to take today. Okay. So the fundamental thing, all past costs are called sunk cost and they are of no relevance whatsoever. If they are of relevance, that has to be specifically addressed in your scenarios when you are working on some analysis. But otherwise, anything that has happened in the past is of no relevance. You want to buy a new machinery, past machine cost has no relevance. So contribution margin, three important aspects of marginal costing: contribution analysis, break even analysis, and scenario modeling. These are the three topics that we are going to cover today. Let's move forward. Fundamentals, we'll talk about break even analysis. So break even analysis in simple terms also called as payback. So how many units do I need to produce to at least earn what I am spending? Simple as that. If I'm producing 100 units, am I able to at least make a 0 rupee profit? So when we talk about break even analysis, the simple equation of a marginal costing would be sales price minus variable cost will be equal to your contribution into number of units will be equal to total contribution minus the fixed cost is equal to your profit. So when my fixed cost will be equal to my total contribution, at that point of time I can say that I am breaking even. So then every unit that I produce after the break even is going to add to my profits. Contribution, the most simple fundamental aspect of contribution is that my selling price should always be more than my variable cost. If my selling price and variable cost there is a mismatch, then my contribution will be also skewed. So there has to be a very good, so in marginal costing there is a direct relationship between cost and your selling price. Okay, cost and sales, units sold and the selling price. Okay, so we'll talk about break even analysis, break even point, and the CVP, cost volume profit analysis. So what is cost volume profit analysis? We'll look at it in Excel. So we'll talk about Excel tools, create some interactive scenario models using what if analysis, etc. Some terms that you are supposed to know: uh, selling price at which the product is sold; variable cost at which, cost that varies with each unit. Cost that varies with each unit in the sense, if I produce one unit, if for example my cost to produce one unit is 10, If I have to produce 2 units, then my cost would be 20 units, and so on and so forth. So the variable cost will vary directly. It will have a direct relationship with the units that I am producing. So that relationship, if it is not there, then there would be some components of fixed cost or semi-variable cost that would be into variable cost. So we have to identify which are the costs which are directly related to my units produced. Okay. All the costs that are directly related to the units produced are called as variable cost. They will vary with the number of units. Okay. Then the third cost is fixed cost, costs that remain constant regardless of volume. So typically for a particular volume, so when we do marginal analysis, one fundamental assumption that you have to make is that my volume, my fixed cost will remain constant for a particular level of production. Okay. Beyond that, beyond that particular level, the fixed cost may also change, because you might have to increase the capacity, you need to have more space, etc. So for that, you have to decide what is the level of production, and what for that level of production, what would be my fixed cost. That has to be fixed, or that has to be determined at the beginning itself. Contribution per unit, selling price minus variable cost, simple formula. Now there are two types of, now when we are talking about costing, we have heard of these words like marginal costing that we are talking today. There is something called as standard costing, there is something called as absorption costing. So the books of account that we use in organizations, okay, the accounting methodology that is used for costing is called as absorption costing. Is called as absorption costing. In absorption costing, the formula is sales minus cost is equal to your profit. Okay, there are two sales minus costs that are directly associated, which is also called as prime cost, or they are called direct cost. Sales minus direct cost is equal to your gross profit. Gross profit minus your indirect cost like sales cost, general administrative cost, etc. They are called as indirect cost, is equal to your profit. And in marginal costing, what we are doing, sales minus variable cost is equal to your contribution minus the fixed cost is equal to your gross profit. So your top line in absorption costing and marginal costing remains the same, sales, and the bottom line is also net profit. But in between, the way in which we classify the cost is very different in marginal costing and absorption costing. Absorption costing, you'd classify it on the basis of direct cost. There could be some costs which are fixed in nature, but since they are directly associated with my production, they are classified as direct costs. Unlike in marginal cost, unless and until they vary in relation to or in proportion to my sales volumes, they will not be classified. They will be only then they will be classified as variable cost. Otherwise, they would be classified as fixed cost. Okay, so that is one fundamental difference between marginal costing and absorption costing. So contribution per unit is equal to selling price minus your variable cost. Total contribution is equal to contribution per unit into unit sold. Profit is equal to total contribution minus fixed cost. Profit volume ratio, contribution upon sales, okay, or PV ratio as they call it, or contribution ratio, or contribution margin, or it all means the same. And break even point is equal to fixed cost minus divided by selling price minus variable cost, or contribution. Selling price minus variable cost is also contribution. These are some fundamental terms that we need to know, or we need to understand when it comes to marginal costing. So this is like, I mean, the preamble of marginal costing. Okay. We'll do now. I'm just going to share what are the activities that we are going to do in Excel. We'll do a contribution calculator very quickly. We will talk about the referencing, absolute referencing, relative referencing, and stuff like that. Very basic Excel, but very relevant when it comes to doing automation, or using the formulas which will be applicable globally in multiple sheets also. So that is that can be achieved by using referencing, absolute referencing, and relative referencing. So input, selling price, variable. So we'll talk about that when we get into Excel. Break-even calculator, we will do inputs again. That is, we'll try to achieve what is the break-even units, break-even in sales, in numbers of units sold, and in dollar terms or in INR terms. Second activity that we'll talk about would be CVP analysis. With it, some data table. We'll have some data and we'll create a CVP analysis. What is the CVP analysis? Helps in understanding how cost, volume, and price affect the company. So if my volume changes, what is the impact of that volume on my profitability, on my contribution? My contribution per unit will remain same, but my profitability at in totality level will change. So contribution, I mean, just the word contribution means how much am I able to contribute for my profits in simple terms. So, I mean, what is the contribution that I am going to generate by selling each unit, which will help me to absorb the fixed cost. And if there is something that remains, the first absorption of fixed cost, after complete absorption of fixed cost, then I will be able to generate profit. So contribution is nothing but how much am I able to contribute towards the profitability of the organization, or how much am I able to absorb the fixed cost. Higher the contribution, better it is. Lower the contribution, bad it is. I mean, bad in the sense, if you have a low contribution, you will have to sell more number of units to absorb the fixed cost. Lower the fixed cost, better it is. Higher the fixed cost, bad it is. Simple as that. Okay. Key assumption: cost can be classified as fixed and variable. So there are two classifications. Fixed cost, I mean variable cost, direct material, direct labor, direct overheads. These are typically variable costs. Even variable cost, for example, if there is a sales manager salary which is associated, which is somewhat variable with respect to the sales unit, that will be also treated as a variable cost. Fixed cost, anything that does not change with respect to the volume is a fixed cost. Simple as that. Say selling price remains constant, selling price per unit remains constant. So when we are doing analysis, I mean, there are some constants that we have to determine at the beginning of the analysis itself. Otherwise, if there are too many variables and too many changes, then that analysis will go haywire and we will not be able to come to proper conclusions. All units produced are sold. So again, we are not talking about WIPs and all, because when we start talking about work in progress with respect to semi-finished goods, there would be so many. We will have to talk about equivalent production and so on and so forth. What is the percentage of units completed, etc. So we are not going to get into there when it comes to marginal costing. So that equation of equivalent product will not be applicable when it comes to marginal costing. All units produced are sold. Product mix remains constant. So we'll talk about product mix. So if I am a milk producing company, for example, a milk, so I will have different types of product: milk, ghee, khoa, or paneer, or cheese, or butter, or whatever. So the product mix will also change. So in marginal costing, we will talk about marginal costing where the product mix remains constant. So we'll do one question, one simple analysis on product mix, as to how to use product mix to optimize my profitability. CVP helps answer how many units to break even. CVP is cost, volume, profit analysis. Okay, analyze how selling price and sales volume impact profit. How many units to break even? What if we change price or cost? How sensitive is profit to volume? So that's one activity. We'll use decision making. So why do we use CVP analysis for decision? Make or buy decisions, accept or reject an offer. So if I am able to recover at least my variable cost, then I may be able to accept an order, even if I'm getting a dollar contribution from that new order. And if I have the capacity available, then I might accept that order. Ignore if the fixed capacity is, if capacity is not available. Okay. Product mix under limiting factor. So if I have to produce, if I am a milk producing company, then I have to at least 100 liters of milk I have to daily produce. Then whatever remains I can use for multiple factor. But then there 100 liters of milk per day becomes a limiting factor. In that case, how will contribution analysis help in deciding which other products should I manufacture? Okay. So I spoke about it. Only relevant costs matter. Fixed costs are sunk cost for most of the short-term decisions. So fixed costs do not matter when it comes to sunk cost. I mean the past costs rather are not relevant in the short-term decision making. And managers love models that respond to inputs. So we'll talk about, I mean, the combo boxes and all that we are planning to do today. That is something that is like, I mean, if you want to wow your managers, this is some fantastic tools which can help him understand, and he can play with those numbers. If I change the volume, what is the impact of profit? If I change the fixed cost, what is the impact? So on and so forth. So you can have a sensitivity analysis done within the model itself. Okay, let Excel do the thinking and you focus on the decisions. So that's what our objective is. Key takeaways, I mean, data tables and scenario manager simplify what if analysis. um, Marginal costing focuses on contribution, ideal for short-term decision. Excel is a powerful tool to build interactive costing models. Break-even and CVP tools enable quick scenario analysis, real-world decisions, data tables, and scenario managers. Okay. Tips and tricks. I'll share the PPT with you guys again. so that you can go through it. And if there are some things that you want more to explain, I will do that. So let me start with Excel right now. I'm just sharing the Excel sheet now. Okay. My screen is visible to everybody, right? So fundamentally, let's start with very basics. I mean, the first step in Excel is to create a boundary. Okay, these boundaries are of vital importance when it comes to Excel or uh, creating models. Okay, you need to decide your starting point and ending point. Ending point in a way in which you are your structure, the framework. I mean, when we talk about accounting, costing, we talk about the frameworks. Okay, accounting framework or costing framework. In Excel also, you need to build a proper framework. If you have a proper framework, then you will be able to replicate and you will be able to manage, you will be able to modify, you will be able to debug. Okay, you will be able to enhance. All these things will be possible only if you have a proper framework. Okay, again, right now we are just looking at one simple table: a selling price, a variable cost, and the units sold, and what would be the contribution per unit, and what would be the contribution of number of units sold, 40% or whatever. So selling price, again, these are just input sheets that we call. Okay, now here, this formula B3 minus C3 is a very simple formula, so to say. Now imagine this to be a table of, say, 100 rows and 100 maybe 20 columns. What the relative and absolute references become very vital in Excel, because anybody have any idea about what is the relative reference and absolute reference? Anybody who can throw some light on their understanding about absolute and relative reference?
Yes, participants, you can answer.
Yeah. So nevertheless, I think when we talk about absolute referencing, okay, that means we are anchoring it to some cell. Okay, the formula to some other cell, the anchor remains constant. Okay, in this case, for example, when I have written as B3 minus C3, right now, is there an anchor? There is no anchor right now. So if I copy this formula and copy it over here in column F, okay, the anchor changes. Okay, the anchor changes from BC to EF. Okay, what is happening? This is called as relative referencing. This is called as relative referencing. How do I convert this into a absolute referencing? Now, if I go over here, now this is a toggle key. Now B3 represents the address of the cell, column B, row 3. Okay, now if I want to do an absolute referencing, there could be an absolute column, absolute row, there could be an absolute column, relative row, there could be a relative column, absolute row, and there could be a relative column, relative row. There are 4 permutations and combinations that are possible when it comes to referencing of cells. Now, if I have to do this as an absolute reference, what I do is there is a function in Excel to convert from relative to absolute and absolute to relative. It is a toggle key function F4. In some computers, if you have a direct F4, you can directly click on F4, go to that cell, go to that number, that formula over there, and just click on function F4. You will see the dollar sign appearing. Okay, $3, $3, $B, $3, again $3, $3, and $B3 and B3. Okay, a dollar before the column, before the row, or the combinations of that. That is an absolute. So I'm just converting it into an absolute reference. So I'm just typing function F4. Now I copy this formula again over here, for example. Now it is anchored to the same rows and columns that I am using. So when we do marginal costing, now, for example, I want to change, I want to create multiple scenarios. This will be very useful. So when we do a product mix or scenario manager, we'll look at that. So this is simple, fundamental relative referencing. Okay, so cell referencing, relative versus absolute, this is the fundamental thing that you have to know when you start working in Excel sheets. Whichever model you use, not necessarily marginal costing or standard costing or business model or whatever you are referencing, if it is correct, your debugging will not appear. You will not don't You won't have to debug the sheets at all. So referencing is vital. Okay, now very simply, I will just give you one more insight. Now, if you see 100 rupees over here, and if you see on the right side corner of my Excel over here, there is a name box. Can you see that name box? There is a B3 written over here. That is a name box. Okay. This naming of cells is also very, very, very vital. When we do a VLOOKUP or XLOOKUP, that naming, how many times you are going to remember which column, which row, which column, which row. So for example, let us do very quickly. Now I have this C14. So um, cost for or selling price, for example, and variable cost, just for example, 10, 20, 30, for example, 30, 40. Okay. Variable cost is say 50% into 0.5. Okay. Now, every time I do a VLOOKUP, I will have to do equal to go column, check the columns, and every time I have to refer to a selling price. I have to keep going to that sheet, finding out where, which column, which rows this is there, and then doing it. Instead of that, I can just give this entire name as selling price. Now, can you see there is no cell now? Okay. So if, for example, now I want to do a VLOOKUP, for example, VLOOKUP 20. Okay, I want to see 20 and a corresponding value corresponding to 20 in this columns, for example. Let me just do this as cost. Both this as cost, for example, or MC, marginal costing. Okay, is equal to VLOOKUP now, comma 20. Okay, comma, I have to select this. Can you see? Can you see? Can you see in the formula? Instead of that, now numbers, I have, the moment I select this, now I don't have to do anything. I just have to see MC. It will automatically select select that cell. MC. Do you see that? Comma 2, comma 0. Is my VLOOKUP becoming much more easier, much more simpler? So naming of this formula, naming of these columns or those arrays, as we call it in Excel, or those data points, your formula creation will become extremely easy. Okay. So this is naming of the formula. Where do I get those names? There is something called as a name manager. Okay. Where can I find name manager? Can you see over here in formulas? There is something called as name manager. Okay, let me just a sec. Can you see name manager over here? Now all these names that I have given right now, MC, I can go and edit over here. It gives me what is the range of cell that I'm using, or what is the array of cells that I'm using. Now, array functions are again the advanced level of Excel. But if you have a basic understanding of arrays, you will be able to create all the business models. I mean, the mergers, acquisitions, all the synergy analysis and stuff like that, or costing or standard costing analysis, or the management information systems report that the management would be requiring. All these things you will be able to do with arrays or even without arrays. So this is the basics of, this is the name manager. I can change it over here. I can give a new name, edit everything. Okay. So let's move forward. So here contribution is 40. Okay. Contribution, total number of contribution 500. I'm not explaining you how that calculation is happening. So I change the selling price over here from 100 to maybe 110. What is the impact? Contribution changes to 45. Okay. So this is a simple marginal costing table. Okay. Let's go to the next level of marginal costing. So once you calculate, so what is the formula? Selling price minus variable cost is equal to contribution minus fixed cost is equal to gross profit. Okay, this is the formula. Let us get into the break-even analysis. Now, I have a table over here. How do I create a table? This is a table. Simple fixed cost for a given capacity is given. Selling price is given as 100 rupees. Variable cost is 60 rupees. Again, this is just a basic level. But now I have to see for different levels of selling price, what would be my break-even unit. Okay. Here in this sheet, what we are going to, I'm assuming that you guys know how to create chart, but we will create the same chart over here again. Now this is a basic table where my fixed cost remain constant for this level. Okay, where my fixed cost remain constant for up to this level. Beyond this level, my fixed cost is increasing. But after that, again, this is 45. I mean, let me do it. It's 75,000, for example. Oh no, this is okay. This is 45,000. The price is going down. So the fixed cost varies. My selling prices is changing. My variable cost is also changing. How do I calculate the break-even point? Very simply, fixed price, fixed cost divided by my contribution, selling price minus variable cost. I use the same formula over here and this. Now, what is the formula that I'm using over here? This is a relative references. Here, can I use a absolute reference? No, I cannot. Okay, here I have to use relative reference. Okay, visible, right? Yeah. So this is a relative reference that I'm using. Okay. Now this is giving me a break-even point in units. Okay. How many units do I need to produce to arrive at a profit zero? Let us verify it. 1250 into 100 minus 1250 into 60 minus 50,000. Do I have a profit of zero? So that's what I'm trying to do. So every time now so the minimum number of units that I need to produce to for this scenario one, where my fixed cost is 50,000, selling price is 100 and variable cost is 60, I need to produce 1250 units. So if I have to make profit, the moment I produce 1251 units, I earn a profit equal to the contribution. Okay, I earn profit equal to the contribution. Okay, I do two more units. Okay, I do 1300, 1250, 50 units into 50 units into 40 rupees. Okay, so this is the contribution that I'm going to earn. Okay, okay, okay. Break-even point. So number of units into my sales will give me my break-even point in dollar terms or in rupee terms. Simple as that. Now, if you observe this table very carefully, what would be the best scenario for me? What would be the best scenario for me? The best scenario would be maybe at this level where I have a break-even point that is at very low number, because now for just by producing 1100 units, I will be able to start making profits. This scenario also is good. This scenario also is good. But here my break-even point is pretty higher up. Okay. And I have to produce more number of units and earn more revenue numbers. Here I earn for example, for every unit that I'm above 1100, I will start making profits. So three best scenarios, 1, 2, 3. How did I do this? There is something called as conditional formatting. I'm not. There are different rules for conditional formatting. Okay, conditional formatting, highlight rules. Okay, greater than what do you say? Great or top three, for example. Let's do a top three. Okay, what we have to highlight. Uh, top Instead of top 10 items, top 3 items, or maybe let's do only top 2 items. Okay, and convert them into red. Okay, here now if you see, there are multiple rules that I've already created. Okay, let us delete one rule over here. Okay, so I've deleted one rule. So now these are the two scenarios where let us delete all the rules and then create again. Okay, it is plain now. Okay, now I want to find out for which level I have a good break-even point. Okay, I do a conditional formatting over here. I will highlight top, maybe top just one item, for example. I don't want 10, I just want top one. Okay, and highlighted it with a red color. Now here the break-even point is very high. The break-even point is very high. So that's why I've highlighted it in red, because this is not a very optimal scenario. I want a scenario where my break-even point is very low. Okay, let us create one more scenario. Do a less number now. Okay, bottom one, and change it with maybe green. Okay, now this would be the best scenario where I have the least number of units to be produced, so that every additional unit that I produce, I will start making profits. So that is how you do a decision. So high BEP, low BEP, I will not work on high BEP ratios, high BEP, unless there is some very obvious reasons or mandate given to me by the management to do that. But otherwise, from an analysis point of view, I will avoid scenarios where the BEP is very high, break-even point is very high. I will look for scenarios where the break-even point is at a low level. Let us create this table very quickly. Okay, this is a table that I have created already. Let us create one quick insert. There are a lot of charts that are already given. Okay, uh, inserting a chart is no big deal, right? I think everybody know how to create a chart. Okay, in Excel, no rocket science. Okay, let us very quickly do a. Now looking at this chart, there are so many things. Okay, there is a fixed, there is a variable price, there is a break-even point. I don't want everything of that, but this zero line, this is very disturbing. What is that? What meaning? What is the meaningful analysis that I can draw? I am not able to understand anything out of this chart, except for the fact that the break-even point varies from 120. I can see a low level break-even point over here, maybe somewhere at $88,000, and there would be an optimal 1,000 rupees, 1 lakh rupees, which is good. Then there is this another line called as, what is this line? Fixed cost, which varies and which goes down. But where are the units? I'm not able to correlate there are units, BP units over here, but I'm not able to this is a flat line. So what do I need to do is, I need to create a, what do I need to do? I will have to find out a way in which I can put those into a secondary axis. Can I do that? Can I do that? Yes. Let me just find out where. Here. Format axis. Okay, let us do it over here. Format axis. Okay. Axis options. Automatically. Where did it go? Just a second. Access options. Just give me a sec. Format data series on secondary axis. Can you see now? Earlier it was on primary axis, where I was not able to understand anything out of it. But the moment I put the units on a secondary axis, I am getting some meaningful analysis. Now there is units also to relate to. Now I have got some correlation. These are three important factors. Now you can create multiple tables, multiple graphs based on this. Okay, there is something called as, let me just delete this. There is something called as spark lines also. I don't know if insert. Can you see over here spark lines? There is something called as spark lines. Okay, everything that is there in this data, again, this will not be very relevant over here, but I'm just introducing you to the concept of spark lines. So it will give me how the data in that row is going to look. Okay, so I just copy this spark lines everywhere. Now people who want to, decision makers, for example, they want to see everything in a snapshot. They have it in front of their eyes. So this is called as spark lines. You can have multiple types of spark lines. You can just go to insert, spark lines, win loss, scenario analysis, columns, etc., whatever you want. So this is a very important tool when you have apples and oranges to be looked at. For example, dollar values and units. Then it is always preferred to use two different axes. In Excel, that is a possibility. You can have some data or units in on X axis, the secondary axis, and dollar rupees in primary axis. So how to do that? Again, go to this data lines, format data series. Okay, put that in secondary axis. You will get the secondary axis data on the secondary axis. Okay, so that is, so the introduction was why I spoke about, so visual plus numerical, okay, will add value to what you do. Just visual may not be of great help, just numbers also may not be of great help. So when you combine visual and numbers, that will be very helpful. Now let us go to CVP analysis. CVP analysis is profit is nothing but uh, 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 units sold into selling price minus units sold into variable price, variable cost minus fixed cost, or selling price minus variable cost into units sold minus fixed cost. This is simple. This is a payoff table. For example, what this is the selling price over here. This is the selling price on the top. Okay, and over here are the units sold. So what happens with my selling price when my selling price goes on increasing and when my units sold also goes on increasing? What is the most optimal level, or what is the break even point for different levels? By looking at this graph, by this table, I will be able to understand everything. Now here also I have done conditional formatting. Let me delete those conditions first. Okay, so there is nothing. So what I am doing is just do a small, now how I have done this calculation? Pretty simple. 50,000 into the selling price minus sorry, B8, number of units sold into selling price minus number of units sold into variable cost minus the fixed cost. That is a simple calculation that I have done. Now I want to create a table which will give me which are the most optimal rules. So highlight rules greater than uh, greater than or equal to 0. Let us do it greater than or equal to 0. Highlight with green and say OK. And again, less than 0, highlight with red. So I have a payoff table which gives me a complete insight as to which are the best alternative that I have. I mean, we see a cutthroat competition across every sector nowadays. I mean, the best case example would be all the colas and all those FMCG products that are being sold. For every one single unit, they are trying to grab their market share. They want to protect their market share. It's not about competition to sell more, but it is a competition to protect the market share. Okay, so how do I protect the market share? What would be the optimal pricing? What would be the optimal units to be sold? What would be, how much fixed cost can I manage? What should be the capacity that I need to have? All these things would be able to, you will be able to do using marginal costing only. So this is a break-even point table at this units or this units. So for 100 units and 1250 units, I will achieve one break-even. Now there could be multiple break-even points for multiple layers, multiple levels. Okay, we need to find out what those multiple levels could be, and because in the long run everything is variable, nothing is fixed. So when we, what we call as fixed cost, that we call it in the short term, but when we talk about long term, everything is variable. Okay, so there would be different layers at which the break-even point can change because the variables will also keep changing. So this is a simple table to analyze a break-even point, to analyze the cost, what is the impact of cost, volume and price. So here is the volume, here is the price, and here is the cost. Okay, now here also again there could be a third element that I can bring in. Right now we have only done selling price and units sold as variables. We can have variable cost also as a variable. Okay, multiple variable cost for multiple levels. You will have a three-dimensional data where you will have to start using something called as arrays in Excel. Okay, let us look at something called as make or buy. Okay, make or buy, uh, if statement. Okay, multiple if statement. So if statement, I am assuming that you might have covered if statement. If function. Okay, if function, if a condition is true, then do this. If it is not true, then do this. Okay, that is a simple scenario. Here we can have a very simple: buying cost is 90 rupees, making cost is 80 rupees, my fixed cost is 20,000, expected demand is 1000 units. Now, how do I find out from this data whether I should buy or whether I should sell? So simple. Okay, if total make cost and total buy cost, I have to find out what is my total make cost and what is my total buy cost. If my make cost is more, I should not, I should prefer to buy. If my buy cost is more, I would prefer to make. So here I can use a simple if loop. Okay, is equal to if, okay, if make cost is less than buy cost, comma, inverted commas, buy, okay, comma, make, inverted comma. So when we are going to use any strings in a function, so all functions are those that will start with a bracket. Okay, their functions are those that will start with a bracket in a bracket. Okay, after the function. So if is a function, and is a function, or is a function. Okay, there are several functions that we will use in Excel. Okay, sum product is a function, or is a function, XOR is a function. Okay, so here by using this simple formula, I will be able to find out. Now imagine that there are multiple scenarios and uh, multiple variations. I can have multiple if functions over here. For example, if buy, I can add one more function over here. If buy, if say buy cost greater than 85,000, uh, don't buy, for example. Don't buy. Okay, comma, make. Okay, here we have just using what condition I'm using. I'm just saying that if the buy cost is more than 85,000, then don't buy. So I'm just putting a function in a function. So if you see, there are two functions in a function, okay, that I've used. So you can have up to, you have to find, I mean, just this is a food for thought. I mean, how many functions or how many iterations can you do in a if function? So if can you go to infinity, or is there a limit given by Excel? That I think you guys, if possible, try to explore. If you are not able to find out, I'll share my number. You can call me. I'll let you know. Okay, so this is nothing but a simple decision making matrix where we will use for a buy function, rent or sublet or whatever xyz. So this is for if function would be used for decision making typically. Let's look at scenario manager. What is the scenario manager? There is something, I think we have 12 minutes. Okay, if you see over here, okay, this is the scenario manager over here. Now I have select this, go to data. There is something called as what if analysis. In this analysis, there is a scenario manager. I've created three different scenarios: pessimistic, normal, and optimistic. So if you see, okay, if you go to summary, if you create just a summary, now I will create those edit. For example, I will create C2 to C4, for example. These are the cells that I've used. By changing, these are the three different scenarios. For each scenario, I am giving some inputs. Okay, C3, C2 is 120, C3 is 60, C4 is 1200. Okay, so the selling price is 120, variable cost is 60, unit sold is 1200. So this is scenario 1. Okay, pessimistic scenario. Okay, this is the scenario. Again, same cells, but now I am giving a different number over here. For a pessimistic scenario, I am giving C2 as 90, C3 as 65, C4 as 900. Using this scenario, now I can just create a summary of the report. For example, here is the summary. Now, I don't have to keep creating summaries, keep creating scenarios every now and then. If my data changes, that scenario manager will be able to adapt. Now, this is actually a automated table that has got created. So if I look at this scenario, let us create one scenario again. Okay, let me add one more scenario over here. Okay, in this scenario, I will say add one more scenario as super optimistic, for example, super opti. Okay, okay. C2, I will say 120, 150, for example. C3, I will say I'll keep it at 60 rupees only. That is the variable cost. And units sold, instead of 1200, I will say 1500. Okay. And I say okay. Now automatically, now I have one more scenario that has got created. And I just say summary. Okay. And it will give me a summary of all the scenarios. 1, 2, 3, 4. Earlier we had a scenario of, we had a scenario manager of only one. Oh, sorry. 1, 2, 3. Now we have added one more scenario that also is getting reflected in the scenario manager. So what is the most optimistic best scenario that I need to explore? In a normal scenario, I will make only 2800 profit. In an optimistic scenario, I will make profit of 28,000. But in super optimistic scenario, I will be able to make 85,000. I mean, in stock market, I mean, people who are dealing with stock markets or people who are dealing with multiple products, this scenario managers is very helpful in analyzing the impact of price changes, impact of volumes, to help understand different scenarios. In one glance, you will be able to understand what exactly I need to focus on. So that is what scenario manager will help you in doing. Is scenario manager clear to you guys? I mean, if there's anything that you want me to add, I mean, I'll be happy to answer your questions. So that is a scenario manager. So once you have a table created, now you can, now over here, you change anything over here, doesn't matter, because in the scenario managers, you have already defined the values. Okay. So that is scenario manager. Let us look at product mix now. This is a simple table. In product mix, now when I have multiple products, I can calculate the contribution per unit. In all these products, I am getting a contribution of $40 only, 40 rupees only. Okay. However, the selling price is different, the variable cost is different, but most importantly, the labor hours per unit that I'm going to incur are also different. Okay. So now, if this is my driver in marginal costing, or in costing, we call it as a driver. What is the driver for that product? If labor hours, machine hours are my drivers, then I have to find out contribution per driver. Okay. If labor hours, then what is the contribution per labor hour? Now, if the contribution per labor hour for product A is 10, product B is 20, product C is 13. Now, what do I need to do? Now, I will produce from a management point of view. If there are no limitations on me to produce A or B or C, then I would prefer to produce only B, because that is going to add more. Let me just allow two people in, because that is now going to maximize my profits for the organization. But what if only 1,000 hours are available? If 1,000 hours are available, then what do I do? I will utilize all 1,000 hours for producing only B. Okay. How many units of B I can produce in 1,000 hours? For example, 1,000 hours divided by number of units. So I'll produce all 500 units of B, but only 200 units of B can be produced. So that will be 200 units of B. I'll be able to produce, I'll be able to utilize 400 hours. Then I will go to this to produce C, because that is the second highest in contribution. So this will be the maximum number of units that I will try to produce. This is the minimum. So typically, this would be utilized in industries where you are going to keep doing value addition. Okay, milk products, petroleum products, or whatever. I mean, any process industries, for example, paint, any paint industries, for example, a white paint to a red paint to a yellow paint or whatever. Which are the products that are going to give me a maximum contribution? In such scenarios, you will be able to use a product mix matrix to calculate the maximum and the minimum. Now, again, here, just your tabulation of data is very vital when it comes to any analysis. I mean, I'm just reiterating that if your tabulation is very good, then you are pretty neat as far as your analysis is concerned. Any questions on product mix?
Yes, participants you can ask.
Okay. So
These are all in marginal costing.
yeah. So anyway, so let us move forward. Let me just cover this last one. Again, I'm going very fast because the 1 hour is too short a time to really cover a lot of things. But I mean, with all apologies on that front, within 1 hour, I'm trying to cover whatever is possible. Okay. Now here is one table. Now I want to do a little bit of automation on this table. I have created this table. Okay. So I have units, selling price, variable cost, fixed cost, contribution, total contribution, profit, etc. Okay. Now I want to now again, let me do this in a other sheet. Okay. Um, uh, 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 mm. Now in this sheet, I have something called as, I want to do the analysis. Okay. Analysis of units for different levels. Okay. And here I want my output. I want to see only, I mean, the first slide, the PPT that I was showing, bosses like to see some what do you call, magic. They love magic. Okay, they want to play with data. Okay, now here there is something called as a combo box. How to find that combo box? I will tell you. There is something called as a combo box. Let me just create it over here. This is a combo box. Let me just delete that. On my Excel sheet, if you can see over here, let me show you how to get a combo box. In preferences, go to your ribbon and toolbar. Go to your ribbon and toolbar. In all commands, okay, in all commands, you just have to go to something called as combo box. There are ActiveX and there are forms. We have to find out what the combo box simple. Okay, so this is also combo. This also is a combo. So we have to find this combo, and you have to just put it over here. Okay, so it's already added. So once you add it over here, you will be able to see it over here in your ribbon. Okay, so that's where you will get a combo box. So all your which are the commands that are available, you go over here, you will see macros, all tabs, main tab, what do you want, you can customize it from over here. Okay, commands, there are so many commands or shortcuts that are available in Excel. If you see over here, thousands of that. Okay, so combo box is a tool. It's a form tool. It is also called as forms. Okay, here is a combo box. I am just selecting that combo box. This is how it will look. I will click on the right column, I will do a right click on that combo box. In right click, there will be something called as a format control. In format control, I will give a input range. The input range is this. I want all the months. So my manager wants to see what is the unit sold in the month of February, what is the unit sold in the month of January, or whatever, or a trend analysis, whatever. So here we are just finding out, manager wants to select month and he wants to see the data only for that month. That is the hypothesis. So I'll select this range, comma. I will give a cell link over here. The cell link would be just next to next column over here, next cell over there. Okay, and I say okay, period. I'll just resize this combo box. I'll resize this combo box. Now, many of us, we have seen this, but we don't know how to bring this. Okay, this is like a trade secret for most of the guys who use Excel. Okay, so here I'm just using this month. Okay, if I select February, if I select September, if I select October, and so on and so forth. Okay, so this, let me delete this. Okay, okay. Now, combo box on its own does not have any legs. You will have to use combo box with something called as an index. Index function. Again, give a range, comma, and 10. Okay. So the output of this combo box is given to index. If you see changing 8 over here, again the index is, it is picking up from that list. Okay. Now what we are trying to do, we are trying to find out what has been selected, and we are trying to create an input for my VLOOKUP or XLOOKUP. Okay, that's all we are doing. So the combo box usage is only to extract data that we can use for a formula or a function later on. Okay, now here is the formula. First formula, there are 2 or 3 types of VLOOKUP: XLOOKUP, VLOOKUP, HLOOKUP, and just lookup. Okay, index and match is also a lookup function. Index and match, when we use it together, it just does the same function as a VLOOKUP. But there is a new addition to the VLOOKUP family called as XLOOKUP. We will see what XLOOKUP is also. So let us do a VLOOKUP. Now I want for the month of October, how many? Again, I'll let me do a naming of number, naming also over here. Okay, so let me call this as month. Okay, then let me call this as units. Okay, I think that should be good enough. Okay, if I want to use units now, is equal to VLOOKUP. Okay, VLOOKUP, what do I need to look up? I need to find out VLOOKUP October 25, find it in this table, okay, and where do I find out? It's in column number 2, for example, and give a false. So the VLOOKUP has 4 parameters. What I want to find, where I want to find, that is a range. In that range, which column I want to find, and true or false. A true represents an approximate value. If that column is, if that value that I'm trying to find out is not present, then it will give the next value, next closest value. But we don't want to use true. There is true is not used. I mean, in my 25 years, I have not used true, maybe on 1 or 2 occasions, but otherwise we use only false. A 0 represents a false and a 1 represents a true. Okay, so that's a 0. Okay. Oops, sorry. Okay, let me just do it again. VLOOKUP. What do I want to find? I want to find a value corresponding to October in this table in column number 2, 0. Okay, it has given me 300 units. Let me just demonstrate how an XLOOKUP also will work. XLOOKUP, for example, I want to find sales. Now in VLOOKUP, HLOOKUP, the problem is I cannot go backward. If there is some value, for example, over here, say capacity, for example, okay, 100, 200, 250, 300, okay. I cannot use VLOOKUP over here now. Okay, let me do that. I will start, the key column has to be the column that I'm trying to find out. So in this case, since month is column number 2, if something to the left of month, if there are values, I will not be able to pick up those values. But with XLOOKUP, now that is possible. How do I do XLOOKUP? Same function, XLOOKUP. What do I need to do? XLOOKUP. I want to find a value corresponding to October. In which column? In, if you see that I've just clicked month and maybe unit. Okay, in name range units. Okay, and say enter. Did I get the units? XLOOKUP. If I have to select this column now over here, I will be able to get, to the left side also. So that XLOOKUP has that additional flexibility to go to the right of the lookup values or to the left of lookup values. Now again, this is just a simple. Let me just very quickly do that. XLOOKUP, I want to find out what is the sales for the month of October. MON, month, comma, into and this column. Okay, multiplied by the sales over here. Okay, the here. Okay, 18,750 is the sales. Again, is equal to XLOOKUP. Okay, October, comma, month, comma, where is the contribution? This is the contribution. Okay, contribution into number of units sold. Okay, 5,200. Forget the profit. Let's look only at this two. Now this is the data. Every time I change this now, the data changes. Let us do it in a proper way now. Let us do it in a proper way. I copy this over here in sheet, the analysis sheet. I copy over here. The problem is it will give you a blank value right now. You again have to go, do a format control. Okay. Go to that combo box. Okay. Go to that, sorry. Input range is this. The months that you are going to select. In combo box. Okay. And here give the cell link, again the same cell link that we have given over here, period. Done. In very quickly, now what do I do? Is equal to, I have already created this. Just give me a sec. Okay. Number of units here, sales here, contribution here, forget the profit. And now output also I can directly link it over here. Okay. Now the moment I change this, all the data automatically changes. Now this combo box I can copy anywhere now. Once that linking is done, this combo box can be copied anywhere and I will be able to replicate it wherever I want to. I can use it in multiple files, multiple sheets, in multiple ways. Okay. So this is a simple combo box that can be used to do a lot of analysis. If yeah, I think this any questions now? I'm open to. I mean, I think we are already 7 o'clock. So if you have any questions, I mean, I will be more than happy to answer your question.
Yes,
All
audience, now you
participants.
can ask the questions. If you want, you can
yeah.
If you want, you can unmute yourself or post it in chat.
Yeah, post it in chat or unmute yourself. I'll be very happy to answer the questions. Again, Excel is a very, very powerful tool. I mean, do you want me to show you one simple model? Actually, I mean, if if that's fine with you guys?
Yes, sir. You can.
Let me just see if I have one. Let me share. So this is a typical, again, something similar to what we do in marginal costing. Okay. This is actually the Accenture. I mean, this is the data that we have collated from Accenture's actual financial statement from financial year 15-16, and we were trying to do a valuation of Accenture. I mean, what are the multiples over here? If you see, I mean, the similar model that we have created. I mean, it's not okay. Okay, a similar model for a terminal value of 3% and a cost of equity of 9%. What would be the most appropriate equity price of this shares? Okay, uh, the way in which the data has been collated and tabulated. I think this is the way in which we actually build. This is again based on marginal costing also and a little bit of absorption costing also. Cash flow, revenue build up, interest, the asset modeling. I mean that we have created, implied multiples. These are the uh, this is the sum total analysis of this entire what do you call? If you see over here in this, I think. Where do I show that? No, I think here we use arrays actually to create this kind of ladder network. there are multiple variables over here. We have created arrays over here, used arrays. So this is one such model that generally I mean, this is like a 6 months course that we take, and in this we get the participants to create this model by by themselves. There are several things that we do actually in Excel, and I think I mean, I also conduct a lot of sessions in various colleges. Excel today has become the necessity, and with AI tools, I mean, with Chat GPT and stuff like that, we are adding a lot many dimensions to the same Excel that we used to do with a little bit of macros. I mean, I don't know how many of you are aware about macros. I mean, we have not touched based upon on macros also. So in Excel, if you press Alt F11, okay, or you go to where we go, data, because I have command F11, option F11. Second. So all Excel is actually in Visual Basic. So if you just press Alt F11 in your Excel, yeah, in this Visual Basic editor, all the controls for your Excel are over here. Now, for example, I want to, there is this sheet, for example, DCF valuation. I don't want to show it to anybody. Okay, but I have to share that file every time. I mean, the one single option that I have is to hide that sheet. Okay, I can hide that sheet. Okay, but hiding, I can just do an unhide. I can give a password also, but I don't want the participant or the person who is going to receive that file to even see, or to that file, that sheet should not be available. So if you go over here, okay, for example, this is the cover sheet, for example. I don't want this should to be shown over here to anybody. Okay, for example. Now over here, okay, all the characteristics of this sheet are available over here. If you see over here, there is something called as sheet visible. Okay, that means right now everybody is able to see that sheet. When we do a sheet unhide, this is sheet hidden. Okay, now I have hidden that sheet, but I go over here and I can unhide that sheet. Now this is actually a protected sheet. Okay, I can unhide that sheet, but if I do a very hidden, okay, very hidden, okay, this is sheet number 10 combo box. Okay, and I save, I won't be able to see that sheet at all. Okay, so this is in that other file, actually the combo box. Okay, this is over here. So I will not be able to see that sheet, nor will I be able to do for, let's do this sheet. For example, I have hide this sheet. Okay, I have hidden this sheet. Now I go to formulas, tools, macros, Visual Basic editor. In this Visual Basic editor, okay, combo box, I can see if see this sheet 11 is very hidden. Okay, I won't be able to see that sheet over here. If I do an unhide, I can't see that sheet. I can see only this. For example, I say okay, okay, that sheet 11, okay, which is that sheet, very hidden. Yeah, very hidden. Now I change it to visible. Only then it will be visible now. Where is this sheet gone? Anyways, this is how you can, I mean, control the. I mean, if you have little bit of you do a little bit of understanding on Visual Basic, you can write. This is a place where you write. Uh, you write your code. Okay, you write your code, the Visual Basic editor. So there are the possibilities are enormous right now. I mean, in Excel also now Google Sheets have also come into existence, that also are changing a lot of aspects when it comes to functions and formulas. So anyways, I mean, any questions? I mean, I'll be more than happy to answer your questions.
Okay. Dear participants, you can ask questions.
I hope that, I mean, this was helpful, productive.
Yes. Since they are all from commerce background.
Okay. And they are all faculty members, right?
Yes, yes.
Okay, fantastic. I think this is wonderful.
Okay, participants, any questions?
Any questions? I mean, you can just post it on your, on your chat box also.
Either
That's
in
fine, sir.
chat. Okay, sir. I think no questions.
No problem, sir. Thank
Yes,
you very
Rishabh. Thank you, sir. Rishabh, you can give.
Okay, sir. As we come to the end of this enriching session on financial analytics, I would like to take a moment to express my heartful gratitude. First and foremost, I extend my sincere gratitude to the Almighty for His blessing, which made this event a success. I extend my deepest thanks to our esteemed speaker, Prasad J. Kulkarni, for sharing his valuable insight and expertise with us. Your session has been incredibly informative and has provided us with a profound understanding of practical aspects in marginal costing tools using Excel. I would also like to express my heartfelt gratitude to the management, Dr. Aloysius Edward, Dean, Faculty of Commerce and Management, Dr. Joseph Charles, Head, School of Management, and faculty members and participants for their active participation. Thank you. Now, I would like to kindly request you guys to turn on your cameras for the group photo.
Yes, participants, you can switch on your camera.
That's it. Thank you.
Yes.
Thank you, and thank you, sir, for your speech.
Thank you so much. Thank you very much.
Thank you, sir. Thank you. A nice
you.
and wonderful thing. We'll have contact with you, sir.
Yes, sir. Thank you. Really appreciate. Thank you so much for giving me this opportunity. Thank you.
Thank you, sir.
Thank you.